This is VTI Explained for Beginners Part 2. Kindly watch Part 1 VTI Explained for Beginners. Check the link in the description. VTI Investing. This is not financial advice but financial education. What does a tax efficient fund mean, and is VTI tax efficient? Yes, VTI is considered tax efficient, especially when you hold it in a regular taxable account, okay? So in the last episode about VTSAX, I remembered I mentioned that VTSAX is less tax efficient than VTI. So tax efficient investing means you get to keep more of your money and less gets taken away for taxes. VTI is built to hold a whole mix of stocks, big, medium, and small companies, and it doesn't trade often. So because of this low trading, it causes fewer taxable events, okay? So there's less tax to pay. In a moment, I'll explain taxable events. To understand what I mean by taxable events, first you need to understand redemption. Okay? Redemption means when an investor takes their money out. So through the process of redemption is where they create redemption shares. And this is where you as an investor you can buy fractional shares instead of whole shares if a particular share is more expensive and you don't have money to buy. So capital gains happen when an investment is sold for more than its cost, okay? When they sell stocks at a profit, it creates capital gains. So by law, they must pass those profits to investors like you in the form of capital gains distribution. So when that happens, you might owe taxes even if you didn't sell anything yourself, okay, because you own VTI. But VTI is an ETFs, and ETFs use a process called in-kind creation and redemption, which helps reduce capital gains distributions compared to mutual funds. So why is VTI tax efficient? Because it holds a lot of stocks and it doesn't buy and sell all the time. It's very tax efficient. That means when the fund makes money, you keep more of it. You keep more of what you earn because fewer trades happen inside VTI. You are less likely to get surprise taxes, even if you didn't sell your shares. So also VTI is simpler. You don't have to worry about extra fees or tax surprises when the fund buys or sells stocks. No, dividends you earn are taxable in the year they are paid. So you can use, when you're using the tax advantaged accounts like the traditional or Roth IRAs, okay, that will minimize your tax bill. Is VTI risky? Here is another excerpt from Yahoo Finance. In the context of bond yields, the outlook for stocks becomes even dimmer. Vanguard says bonds should deliver 4 to 5% average returns over the next 10 years. Risk-free 10-year treasuries currently offer 4.2% yields. So, why would you put your money into risky stocks if you're going to get the same or even worse returns as you'd get in bonds guaranteed by government? So, is VTI risky? First, you have to know every investment has an element of risk. There is no investment with zero risk. VTI is 100% US stocks. So you're exposed to the US market risk and sector cycles. By sector cycles, I mean a particular sector like technology. Let's say technology. For example, Vanguard shows technology has a big weight, like approximately 35.9% in VTI. So that concentration can amplify gains or losses, okay? Then market risk drawdowns happen. For instance, VTI fell with a big market correction in 2020. You know what happened in 2020? You remember COVID and what happened to the economy. So you're now afraid of VTI, you want to run to SPY. So is VTI or SPY better? SPY and VTI both offer diversified low cost exposure to the US stock market, but SPY's concentration in blue chip firms has led to better returns and lower drawdowns. Okay? Remember, VTI includes mid and small caps, which can boost returns in early bull markets but also increase volatility and downside risk during downturns. Okay? Even though VTI has some risk, why do people like VTI? So let's let's look at the advantages. It can help you answer the question, is VTI right for me? So can you fit VTI into your financial plan if there are more advantages? Okay. Remember, there is broad diversification. Remember the low cost. Remember, it is easy to trade and the tax efficient structure. Why is VTI easy to trade? Many people trade it every day. So, VTI is high volume and extremely liquid, meaning if you tell your broker, sell this now, it will happen almost immediately during market hours. So, ETFs like VTI rely on a system called creation and redemption, which I've just mentioned, okay? And they are special market participants, the authorized participants. They can add or remove shares as needed. So this keeps buying and selling flowing smoothly. So let me use a simple example. Imagine VTI is a big magical cookie jar. So if you want to buy a cookie, like you want to buy shares, or you want to put one back to sell shares, it's so easy because there are plenty of cookies there, so nobody gets upset. That's because lots of traders are also getting and giving back cookies. So those helpers are the ones who can do the trade, okay? They keep refilling the jar or taking cookies out. So it's never empty or overflowing. There's a good balance. That means you don't have to wait or pay extra to trade VTI. It's smooth, it's fast, and it's fair. So knowing liquidity is so important because you can trade fast. It's just like you can just take a cookie when you need it. Then the price stays fair because the jar is full and balanced. Your trades don't change the cookie price much. When you sell and buy, you don't cause a fluctuation in the price. So also you don't have to be worried. You don't have to be scared about being stuck with shares you can't sell quickly or for the right price. Connected also to the previous point is the splitting of shares. So has VTI ever split? So what do you mean? What do I mean when I say split? Or what is a stock split? A stock split is when a fund or company splits its share into multiple new shares. So imagine you have one big cookie, just one. In a 2-for-1 split, that cookie is cut into two smaller equal cookies. So you still have the same amount of cookie overall, just more pieces. Why do funds like VTI split their shares? Why do they do it? By splitting their shares, they can keep the share price approachable for more investors. In 2008, VTI's share price was above $100, but a split brought it lower and made it easier for newer or budget conscious investors to buy. They had less money, so they wanted to invite. If the investors have less money, they can invite more by splitting the shares because it will bring the share price lower. Okay. And by bringing the share price lower, we get to the second point. They increase the trading liquidity. After the split, more shares are available, which often doubles trading volume. And this makes it simpler to buy or sell without affecting the price too much. Let's say you have invested in VTI and you hear from the news or you read from their website that they have done a share split. How does it affect you? So as a beginner, you should know that no real value is lost or gained. If you had $1,000 worth of VTI before the split, you'd still have $1,000 after. It's just spread across more lower priced shares. Then it makes investing easier because lower share prices can feel friendly and more accessible if you're starting small. Okay. Then there's better trading flexibility. So more shares at a lower price means trades can happen more smoothly and efficiently. So you didn't lose anything. VTI has undergone just one stock split in history. That is June 17th, 2008. VTI executed a 2-for-1 split, meaning investors received two shares for every one share they previously owned. So this doubled the number of shares while cutting the price per share in half. But the total value of your investment does not change. Is VTI good for retirement? So let's see what this piece from Jason Kiefert of Morningstar. Let's see what it says, so that you can judge whether VTI is good or not. Okay. He says the first choice investors need to make is whether to pick one of the balance funds that's invested 100% in the US or one that's diversified across the globe. US focused balance funds have been hard to beat since the 2008 financial crisis, thanks to chart topping performance from technology companies like VTI. But as we saw in the first quarter of 2025, non US stocks can still outperform under the right circumstances. And investing outside the US can also enhance overall portfolio diversification. VTI is a smart option for retirement, especially if you are just starting out and you've got 10 years before retirement, because it gives you a slice of almost the entire US stock market cheaply and easily. You don't have to worry about choosing individual stocks. You just invest and climb as the market grows. And over the decades, it's shown solid long term growth. And that's exactly what you want when building for retirement. But if you are near or in retirement, you have to be aware of the following points. One, VTI has higher volatility than bonds. It's more reactive to market swings. That means bigger ups and downs than bond based funds, okay? Then VTI lacks international diversification. It focuses only on US stocks. For global exposure, you'd need to add international funds to your portfolio. Then, three, you may need bond exposure over time because as retirement approaches, as an investor, you need to shift some holding into bonds or defensive assets to reduce risk and protect your income. Finally, let's see how your money will grow using compound interest. Okay, so we are going to start with the minimum, which is just $1, but you want to get to $100,000. So you want to answer the question, how long will it take for you to get to the $100,000? So what you see on the screen, that is the formula they use to calculate the future value of your investment. Don't worry, you don't need to cram. So working with the 10-year annual rate, okay, trailing it to 30th June 2025, that is an annual rate of 12.9%, okay? So our monthly rate will be that 12.9 divided by 12, okay? So that is where you get the 0.01075. Remember, your initial investment is $1. So we are going to use that formula there to get to now calculate how your dollar is going to multiply over the years. And also we need to know how many months it's going to take. So we are doing a backward calculation to get to from $1 to $100,000 because your target can be different. It can be 200, it can be 300, it can be a million, but we are just targeting $100,000 so that you see how easily you can get there. So when we solve for n, which is the number of months or years, you get 230.43 months. So you'll say it's about 19 years and 3 months. So using the formula there, you'll see that your dollar will get to $11.82, okay? But every month you will be depositing $100, okay? So you will only start with $1, but monthly you'll be doing like buying worth, uh, you will be investing $100, okay? And also remember, I've not accounted for any reinvestment or any dividend, okay? So I'm just calculating using the $100 you'll be buying because I can't, at the moment, I cannot measure what will be the dividend, how much dividend will they pay, okay? What will they declare? So we are just working with the $100. Let's say you just cap it at $100. It could be more, but we're just working with something easy, something manageable for you after starting with a $100. So once you calculate using the formula, you see that your $1 will compound to the $11.82, okay? That is after the 19 years. So your $100 using the formula also will compound to $100,673, okay? So adding the two, you get $100,000 685.46. That is stress free. So remember, it must not be 100,000. It can be or even a million. So you just do a backward calculation, but it will be even, you'll get to your target in a lesser period compared to what you have calculated if you use this backward calculation, because there is dividend and there's reinvestment. So are there any restrictions or requirements? No, you're not, it's not a must that you buy you invest every month into VTI. Maybe some months you may not be able to push in that amount, but always remember your plan and try your best. So there are no restrictions, there are no forced deposits. You are not obligated that once you've started with $1, you have to do it every month. No. VTI gives you the flexibility to invest whenever you are ready. But don't forget settlement timing, okay? I want to bring this to your attention. While Vanguard doesn't hold you to a schedule, okay? Remember that if you are setting up automatic investments, that money must first settle in your settlement fund before buying shares. So anytime you're doing electronic transfers, it may take up to 7 days to clear. So maybe you may do some transaction and it may not reflect. So take that into consideration. Suppose you want to withdraw your money. So can you withdraw or sell your money from VTI? How does it work? Yes, you can sell your VTI shares and access your money anytime during market hours. And let me explain how it works. When you're selling shares, just place a sell order through your brokerage account. Then the transaction happens in the secondary market where the ETFs like VTI trade like stocks. So you don't need to deal directly with Vanguard for redemption. No. Then we've got the settlement fund that I've just mentioned. The money you get from selling VTI doesn't go straight to your bank account right away. No. First, it lands in your settlement fund, a temporary holding place in your Vanguard brokerage account. Okay. Then from there, you can withdraw the cash to your bank, or you can buy other securities, or you can just let it sit until you're ready to use it. So, are there any restrictions on who can invest in VTI, or can you invest in VTI from anywhere in the world? VTI is not limited to only US investors, but it is also not automatically available to everyone worldwide. There are rules depending on where you live and what your local regulations allow. So VTI trades on the NYSE in US dollars, okay? Because it's a US security, you must have access to a brokerage account that can trade on US stock exchanges. So you can invest if your country allows you to open a US listed ETF, and you have to open an account with a broker that supports foreign clients. So according to your location where you are, you have to search for a broker that supports foreign clients, okay? And that they can trade on the NYSE in US dollars, okay? Also note that some countries block or limit retail investors from buying US listed ETFs because of disclosure rules, like the EU's PRIIP regulations. Okay. That regulation just aims to improve the transparency and comparability of investment products for retail investors across the European Union. So you have to check on that. Also, remember that non US investors are subject to the US withholding tax on dividends, typically 30%, or it may be reduced if your country has a tax treaty with the US. So you may also have to report and pay your taxes in your own country on capital gains and dividends. If you're interested in a particular investment product that I've not yet covered in my channel, please just share down in the comment section. Remember to like and subscribe so that you can be notified when I post the next video. So today I've covered VTI, but what is the difference between VTI and VOO? And should I pick VTI or VOO? I'll cover that in the episode covering how to invest in VOO. So let's meet next time, and thank you.